Hi there, Adrian here, mortgage broker based in Sydney. On this channel we talk about all things lending, finance and investments. And on this video we're going to focus on the ramp phase, the consolidation phase and the end phase. And we're going to apply that to me personally, what I'm doing on my investment property journey. So before we start, if you like these kind of videos, hit that subscribe button, hit that like button and leave me a comment if you're liking these kind of videos. Let's jump straight into it. So right now I'm in my ramp phase, and my first property purchase was at the end of 2020 in December. And normally from an investor point of view, if you are looking to go towards the maximum amount of properties and max out your borrowing power, it's normally going to take you between 2 to 4 years to max yourself out, depending on how many properties you want to go to and how quickly you can either save up the deposit or how quickly you can revalue properties, pull money out and go again. All right, so everyone does it in their own timeline, and normally it's within 2 to 4 years. All right, so with me personally, I've got my first probably 8 properties are going to be in Commonwealth Bank. Okay, that's the lender that I've chosen because I'm self-employed. My tax return is greater than 20% on the prior year, and it's ramped every year for the last 3 years. So if I go to other banks, they're not going to use the most recent year and increase my borrowing power. So I was forced to use ANZ, Adelaide Bank or Commonwealth Bank. So in my ramp phase, I'm maxing myself out with Commonwealth Bank. Okay, and then on my 9th or my 10th or my 11th property, I'll be using First Mac in the mid-tier banks. So they're a lender that mainly does investment properties, and there's no debt to income ratio caps. So normally you can get to about 6.5 to 7 debt to income ratio on Commonwealth Bank, and then above that you go to First Mac, and I'm a mortgage broker, so the highest I've gotten clients to recently in the last 3 months was an 8.8 and a 9.2. Okay, so I go to First Mac, make 2 or 3 purchases there, and then if I want to go and really max myself out, I can go to Pepper Money after that, and they've got really good policy if all of the investment loans are interest only. So maybe you can squeeze out another 1 or 2 there if I want. And lastly, if I really want to start going hard, I might be able to do a couple of no-doc or self-dec declarations with a lender like a Rate Money or a Resimac, where I self-declare my position, I don't supply any documents, and I just get an accountant to sign me off as long as I've got a 20% deposit. So I could potentially add another 1 or 2 there if I wanted, if I either didn't want to go to Pepper or after going to Pepper. So that's kind of my process, and it's going to take me up until about March to May of next year, and I should have anywhere between about 10 to 12 properties when I'm maxed out. All right, so one thing when we're looking at lenders, you've got to think about the lender that can get you to the max and which stage you get to with that lender, what the next lender is, and what the structure is to get to the next lender and why. Okay, so a lot of the time what I'm going to do personally and what my investor clients do is, one, you can't chase the best interest rate product on the market, because most of the time they've got some sort of issue with their policy that causes you an issue with getting your next property or ramping a big portfolio. So I'll give you a couple of examples. I had some clients that wanted to go to a big 6 bank, I won't say who it is, that was taking 15 days to pick up a file about 18 months ago. They wanted to chase the big refinance cashback deal with an okay rate, and then 6 to 12 months later they came to me to revalue the property, pull extra money out, and then they wanted an investment property. But what they found was that because the SLAs and the service levels were so slow, it took them 3 to 4 months to do the top up. They got annoyed and they wanted me to refinance them out of that lender because obviously it wasn't suitable for ramping an investment portfolio. Okay, the other thing is if you're doing it the quicker way, you're doing 10% deposits on investment properties, so you've got a 90% LVR loan. So a lot of banks, they jack the interest rate up really high on the higher risk loans. Okay, so half of them don't want to give a good deal on a 10% deposit, especially for investment, on interest only variable, so with an offset. So you've got to sugar pick the banks that allow you to do that. Okay, the next one is if you are doing a lot of ramping. So in my personal journey, I've revalued my first property and my fourth property already once each, and I'm just about to revalue my fourth one for a second time to load up a second deposit. Okay, so if you're dealing with a bank that's got a bad cash out policy, okay, so if you're pulling money out of a property, the bank's going to give you two options. All right, they're going to say, we're going to allow you to control the funds. So revalue the property, top up the mortgage, and then any excess goes into your offset account, and then you fully control the funds. But half the banks don't do this. They control the funds. All right, so especially if the amount's over 100,000, what they do is they formally approve you on the top up. They give you a pre-approval to buy, and then from there they never give you the money. You go out, make a buy, okay, and then go under contract, align the settlement, and then the top up and the purchase get done on a simultaneous settlement. All right, and a lot of the time these simultaneous settlements, because you're having to manage multiple banks, not just the seller's bank, your bank, and the top up, you've got multiple departments that need to set up for the settlement. So it causes issues, and let's just be honest, people don't like banks controlling their funds. They want to be able to have the freedom to do what they want with the money. So that's another one. Another one is some banks give a great deal on variable redraw at the 10% deposit mark for investment, but some banks don't give a great deal on investment interest only variable with an offset. Okay, and the reason why you have offset is you separate the funds. It's easy to tell you transferring money into and out of that account and what the purpose is, and it's easy for the ATO and the accountant to see it. If you use redraw, it bulks all of the funds together, so it's hard to figure out which transaction is which and what the purpose of the funds is, and causes issues with your accountant and the ATO. So I'm a big proponent of focusing on offset. So if you look into my net bank, I've got at the moment, I think I've got about four offsets, and I've got two more set up for my fifth and sixth property. So I've got 6 offsets, and by the time I end up, I will have 10 to 12 offsets, which is all separated. And not many banks give you all of the separate offsets with no extra fees. Okay, so that's another one. So you've got to be, everyone looks at the interest rate, but they don't understand the types of banks that they should be using to ramp a portfolio, and which bank they go to after that, and which bank they go after that, and what structure they need at each point to maximize what they're doing. All right, then you get to your consolidation phase. So this is the phase from about May next year when I stop buying. All right, I'll be in a position where I've got 10 to 12 properties. Most of my rents are sitting at 6 to 8% yields. I don't care about any of these interest rate increases. It doesn't bother me. The yields and the rental that I'm getting is so good that rates could go up 2, 3, 4%, and I'm still ahead with how I've structured this portfolio. All right, so here I am sitting with over $2 million worth of investment debt, and my wife is happy. She's not stressed. I'm not stressed. The portfolio pays for itself, and even if I didn't put $1 of my business income into my portfolio, every one of those properties would pay themselves off on a conservative basis at about 14 years. Okay, so it's not even going to take 30 years to pay off all of those mortgages. It'll take about 14 years on my calculations. All right, so when we're in the position when we've got your consolidation phase, that's when you need to figure out, one, where are you going to refinance? Because in your first 2 to 4 years, you focus on the banks that are going to get you to your max and do it easily. Second phase, you've got to focus on what bank could you potentially refinance to, how do you qualify for that bank, and what structure do you need in the future. So I'll give you an example. Myself, I've got a 5 to 7 year goal to get my wife into her end goal property, which will most likely be in the $1.5 to $2 million range. We're looking at some of the acreages in Brisbane, in South Brisbane, closer to the eastern suburbs. So if we can find a really nice house, 2 suburbs from the water on some acreage, I would really like that. All right, so now that we know that I'm going to have some owner-occupied debt, maybe in I'm already 3 years into the journey, so into my 3rd year, just the start. So most likely in the 5th or 7th year of that process, we'll go ahead and we'll buy our owner-occupied property. All right, so at that time, we know that we've got non-deductible debt, which is the owner-occupied. So there's a couple of options. So one, we could stay interest only on the whole portfolio, okay, and funnel all of the principal payments on every one of those investment properties to the owner-occupied to pay that debt off first. Keep the investment debt high, so from a deductible point of view, the interest is deductible on the investment properties, it's not on the owner-occupied. And bear in mind, I'm talking about my personal circumstance, why I'm structuring it and what I'm doing. So I've spoken to my accountant and they're playing an active role in this. Okay, so you need to be taking advice from a qualified professional. I'm just talking about what I'm doing, and I'm always making sure that my accountant knows the structures and what I'm doing and why. All right, so for me, I want to stay maybe interest only for the next 5 years after I purchase the owner-occupied and allow my investment properties to pay off my owner-occupied, all right? Because what's going to happen is, I'll give you an example. At my 7th property, my rent's going to be anywhere around that kind of, my interest only payment is going to be anywhere around kind of 80 to 90,000. Okay, that's on my 7th property, but my rental after I put my granny flats in will be around kind of that 200 to 210 grand mark in rent. Okay, so there's a surplus of about 120 grand there total. All right, and obviously that surplus is only going to get larger the more properties I buy. So at the point when I get to 10 to 20 properties, most likely my surplus will be anywhere between about 180 to about 220 total. All right, and that's using conservative interest rates and figures, and the only reason why I get that is because my rental yields are so high, and the types of properties I go after. All right, so what we're going to do is we've got the interest only payment, and the difference is just on about 200,000. So then we use that 200,000 to pay off the debt that we take out on the owner-occupied property, and you do that over like a 5-year period with me running my business on the side. And most likely we're going to pay off that owner-occupied property in about 5 to 7 years maximum. And by the time I'm age 34 at the moment. By the time I'm age 45, I'll have no further debt on owner-occupied, and most likely half of my debts or more is going to be gone on my investment properties. All right, so that's kind of the structure that we're talking about. Other people in their consolidation phase, they don't have, either they've got owner-occupied debt or they've already paid off a good portion of it. So a lot of the time people, what they do is when, hopefully over this time, your values have gone up, hopefully over the time your offset balances have gone up, all right, and you're in a position where you're not like me, you don't have a large owner-occupied debt. So you may choose to go principal and interest repayments on this, and because the value of the properties have gone up compared to your loan balance, you might be on 60 or 70% LVR, which enables you to get really good interest rates. Okay, and principal and interest rates are better than interest only rates. All right, so at that time when you're in the consolidation phase, that's what you do. I'm a little bit sick at the moment. So that's what you do. You transfer everything to principal and interest to pay it off quicker. You refinance to a much lower rate to get your rate down. And then you use that lower rate to aid your repayments and pay the loans off quicker. All right, so at the end of the day, there's not one size fits all or one size that fits every client that's in front of you, and all you do is you present options and then you kind of mold it around your scenario and situation. All right, so my end goal is 5 to 7 years max from the first purchase to get my wife her end goal property, and then another 5 years on top of that, maybe 7 years max, to pay off the owner occupied and have at least half of the investment debt gone. So I'm age 34 now. I started at age 32, late, and I was just 32 when I started this. So I could potentially retire, most likely by maybe age 38 to age 40 if I wanted to, or I could just run the business up until about age 45 and then be fully financially free. So I'll be sitting on a portfolio of property in and around that kind of 5.5 mil mark total, and that will be what I'll be sitting on as of next year. Okay, and if you're even talking about small growth rates of 5% a year, you're looking at a property portfolio going up, anywhere from 250 to 275 grand a year in value. That's tax free because I'm never going to sell the properties, and I've got a cash flow on that property portfolio. I'm hoping anywhere around that kind of 350 grand mark, maybe 400,000, depending on the however many properties I get to with my maximum. All right, so. And then I'll be in a situation where at that time I'll have net, based on my interest only payment, I'll be clear by about 200,000. So I could choose to retire if I wanted on that money, or use that money to fuel my owner occupied purchase, and then potentially use that money to pay down some of the debt over the time, and obviously build my wealth over time as well. All right, so that's really the three phases that you're at. That's your ramp phase, your consolidation phase, and your end phase. That's how it applies to me. Most likely I'm about 2 to 2.5 years away, and maybe 2 years away from doing a large refinance to get my interest rates down on interest only, revalue my properties, get them under say 70% LVR, and then get some really competitive pricing on my interest only rates. So I may get my rates from a low 3 to a mid 3 down to like a mid 2.5, just because my values have gone up and I've stacked money in my offset. I've got myself in a much better position, and then a lender sees me as a lot stronger position, and then they'll enable me to refinance across to them as a self-employed person, and by that time I'll have 2 side-by-side tax years that are very similar in income. So then I can go to any bank. I'm not forced to go to an ANZ, an Adelaide Bank, or a Commonwealth Bank, who have the better self-employed policy. So hopefully this video shows you that there is a very succinct process that you go through. There is an order that you go through, and there is reasons why you do things in the certain phases of your journey and why you do it. All right, and not just that, I'm not just talking from a Booksmart's point of view. This is exactly what I'm doing in my personal life and what I'm doing with my wife to build our wealth and our try and get financial freedom for ourselves and try and get us what we want in our lives. Okay, because I've seen so many people work the same job until they're 60 and then they don't have any super, and I see so many people that are on large incomes and their living expenses are through the roof, and they're not managing their expenses well, and they're living paycheck to paycheck even though the household income's over 300,000 a year. And I just think I don't want to live my life like that. I want to have a little bit of delayed gratification now for a much better life. And I didn't want to go down, I'll be honest with you, I didn't want to go down the stocks and ETFs route because I knew it would take so much longer to get to financial freedom. And I didn't want to stop work. I just wanted to have the choice of doing what I wanted when I wanted. And I believe that the kind of trajectory that I'm on, I started at age 32. I think that if I wanted to, if we didn't go for such a big owner-occupied property, we pretty much could have retired on more than 200 grand a year just coming from the portfolio. We could have done that inside of about 5 years. So I'm age 34 now, so it could have been by about age 37, 38 that I got to a position where I exited the system. I stopped my business. I stopped working, and I just had the property portfolio, and then I just become a lifetime investor, putting money into super, putting money into shares, putting money into ETFs, having a good amount of money to live my life, start a family with my wife, and really live life on my terms as opposed to life, business, work, family dictating to you. You can really exit that system and focus on what you want to do in life, and that's really the reason why I've done this. And not just that, I want to. With Maria and I, we're trying to start a family at the moment. This has given me options, not really to focus and just have 1 or 2 kids. I could potentially, if we're lucky enough, you never know with life, but I could potentially have 2, 3, 4 kids as long as Maria's healthy and she's happy. We could potentially have a larger family now with the decisions that we've made in our lives and how we've done it. All right, so I think a lot of the time when you see these kind of people that talk about their large portfolios that they've built, they haven't been very specific on what they've done at each stage and why. And they haven't really talked about that from personal point of view. So I love YouTube, and I love the fact that people talk about the areas they bought, the prices that they bought for, but they're really not talking about the mechanics, okay? They're not talking about which lenders they went to and why. They're not talking about why they go interest only at certain times. They're not talking about why they only go for offset. They don't talk about, what their interest-only payment is compared to the rent that's coming in, what buffer it is. They haven't talked about how quickly they ramped their portfolio. Like, there's just a lot of gaps in what I see. And it's not because they're not trying to be transparent, because a lot of these YouTube guys, they're being more transparent than the majority of people out there. And I love that. That's one of the reasons why I started this journey. All right, so I hope that you're really getting a lot of value in these kind of videos, and by the time that I go up to Brisbane, I will be in a situation where I'm going to do a lot more on-site stuff. I'm going to do a lot more stuff with my phone, taking selfie videos and the footage, and then I just hope that you see the choices that we make over time, why and where we get to in our lives, because what we're essentially doing is, while the news is saying the worst things and everything's hyped up, and on the news you only see the positives and the negatives. You never see a neutral mindset, okay? And at the end of the day, all the news is saying that the property market is going to crash, and here I am saying that this is the biggest buying boom that you are ever going to experience. And if you don't get in the next 1 or 2 years and then ride the boom until the end of this cycle, you could potentially miss one of the biggest kind of wealth gaps that's created by inflation. Inflation is the biggest killer of the middle class. If you don't own property and you don't ride this boom, there's going to be a situation where you're further priced out of the market. All right, so hope that you've really enjoyed this video. Hit that like, hit that subscribe button, leave me a comment if you're liking these kind of videos, and we'll see you on the next one. All right then, bye.